I'm Jason Stipp from Morningstar. 2008 and 2009, we hope, were some abnormal periods for the market, which saw a lot of volatility. As you look back at your portfolio and the performance of your mutual funds, how should you assess them during such a time of unrest? Here with me to offer some tips is Morningstar's Christine Benz. She's Director of Personal Finance. Thanks for joining me, Christine.
Jason, great to be here.
So I think one of the things that investors naturally look at when they're examining their portfolios are the returns. And I don't think that that's the only thing you should look at, but they're going to look at returns. I'm going to look at returns. We all are.
Right.
How should you think about returns, especially in such a volatile time?
Well, I do think the 2008-2009 period provides a bird's eye view of just how volatile a fund is apt to be, and pretty much everything except government bonds went down in 08. But if you had a fund that really hit the extremes, that's a good indication that it will probably be volatile on a forward-looking basis as well. And the flip side is true in 09. The riskiest stuff went up the most. So it's a good lens to view whether you're adequately diversified or not. As Jason Zweig has said, unless you have something in your portfolio that really hurts to own, you're probably not diversified. So in both years, you want things that were toward the top of their categories and in the bottom of their categories. That's a pretty good signal that you've got some adequate diversification in your portfolio. And then you don't want to get hung up on 08, 09, even though they were a searing experience, both bad and good. You want to take a longer view if you possibly can. So if a fund has a longer term record, a 5 or ideally a 10-year track record, that's the number you want to focus on. You have to recognize that 08 and 09 are baked in there, but it will give you a view of how a fund is apt to behave over longer time frames, which is more helpful than that short-term view.
Just 08 and 09 maybe gives you a sense of the pressure points and what can happen, but really, not necessarily should you extrapolate from those years for the longer-term performance. So, beyond returns then, if I'm trying to gauge my fund, if it looks like, they did reasonably well compared to their rivals over that time period, or I was able to hold on to them, beyond that, what can I look at to gauge whether this is really a fund, that did actually do well or just got lucky during these time periods?
We always say to anchor your decision making in the fundamentals of the investment. So you want to focus on, obviously, the management team, whether there have been any substantive changes there. Expense ratio is very important. We've been through a period where there's been a lot of upheaval at the fund company level, layoffs, companies merging, situations like that. So you want to take a look at whether there's been anything meaningful going on from an organizational standpoint that would affect your funds. But by all means, focus more on those fundamental factors and less on the rearview mirror of what returns tell you if you possibly can.
Sure. And you mentioned before that, depending on how your funds behaved, and some of them may have been in the top or the bottom quartile during those really, rough times. I mean, what kinds of lessons can you take away then from such a volatile time, maybe about your investments and about yourself and where you'd like to see your funds in such a time like that? That's
a great question, because I think a lot of people saw their investments go down in 08, were paralyzed, so they stuck with what they had. Maybe they didn't. But if they stuck with what they had, what they saw was a great rebound in 09, continuing into this year probably. And so they might be just inclined to say, oh, I can probably live with those periodic downturns. But if a fund really hurt to own, if it kept you up at night, if you could not live with that sort of loss, consider cutting it loose now. You've enjoyed a nice uptrend, very likely, in that same investment. It's probably a good time to take what you learned about yourself during that down market and incorporate it into the way that you're managing your portfolio and get rid of some of those ultra risky investments.
Sure. Christine, thanks for helping us reflect on a very volatile time in the market.
Jason, thanks. My pleasure.
For Morningstar, I'm Jason Stipp. Thanks for watching.
At Morningstar, we feel it is important to schedule regular checkups of your investments. This is the reason we're pleased to announce Portfolio Monitor, a new and easier way to keep track of your investments. With a few clicks of the mouse, receive a monthly report that provides a comprehensive and customized summary of your portfolio, sent automatically to your inbox. Portfolio Monitor provides a concise digest of all the best features of premium membership. Become a premium member with our 14-day free trial to start receiving Portfolio Monitor today.